Hi everybody, Alex Deploy here from Expert Forex, and in today's video I'm going to show you how to turbocharge your trading results as well as manage risk. Now the principles I'm going to be showing you are incredibly simple but extremely misunderstood. Not understanding these principles is the major cause for blown accounts by beginner traders and even experienced traders. Now one of the reasons why I'm showing you these principles is that we are launching a linked account service in the next 2 to 3 weeks, which will enable the trader that is really battling with their robot trading or manual trading to just merely link to a successful trader that already has proven results and a nice track record. Now, if you want more information about this link service, please use the link that is shown on your screen. A clickable link will be available in the description of the video as well as in the first commentary of the video. So let's get straight into it. So the two tools that we use to turbocharge our results and manage risk are two very simple tools. They are position sizing or lot sizing. It's basically the size of your trade, and then your account size. Very simple tools, but I'm going to show you how to use those tools effectively to make a lot of money and to reduce risk. So let's firstly look at position sizing. And I'm going to take that example of in this particular service that we're giving, trades get given to the participants in the service, and they will be in the format of, say, buy the euro using one lot and a stop of 20 pips. So that's what you will be receiving, and immediately what that tells you, that if you trade one lot, your potential loss will be $200, because 20 pips, which is the stop loss, times $10, which is the normal price of a pip when using a main lot, and then times one lot is $200. So if you're aggressive, you'd want to increase the risk. In other words, you want to, because if you increase the lot size and increase the risk, your return will be proportional. So one of the things you could do is simply say, now I'm not going to trade one lot, I'm going to trade 2 lots for this particular deal, and that will increase your risk, because all of a sudden you stand to lose $400, which is basically the 20 pips we saw before times the 10 pips. So, and now you are multiplying it by 2 lots. So it is $400 that you can lose on that transaction. That's a way of increasing your risk. Now, if you are new to this particular technique or new to following this particular trader, you'd want to decrease the risk. Now, the way of decreasing the risk is just simply lowering the lots that you're receiving. So instead of you trading the one lot that the trader's trading, you say, no, I want to only trade half of what the trader's trading. So what you would do is you would only trade 0.05 lots. Now that would immediately decrease your risk, because now instead of exposing yourself to a loss of $200, you are now exposing yourself to a loss of $100. Again, the calculation is shown there. Now, I hope you get the concept here. So you can use lot sizing to leverage your risk up or down, or you could use it to leverage your gains. So the higher your risk, the more your gains will be. The lower your risk, the lower your gains will be. But it is a fantastic and very, very simple tool to use to manage risk. Now, here's a practical example. Here's a list of the traders that we're making available for you to link your account to. And I'm just going to take a simple example of, let's say you like this link 05 trader, and this trader is making 120% return in a month. The trader is using a $10,000 account, but the trader is quite risky. There's quite a big drawdown. So you're not very comfortable with following the trader as is trading at the moment. So one of the things to do is simply lower the lots that you're getting from the trader. So if the trader's trading one lot, you trade half, or you could even lower it to whatever you want, 20%, 60%, or whatever you want. But what that will do is it will create a less risky environment for you. So what you would do is, for instance, and I'm just using this as an example, let's say you halve the lots. So instead of earning 120% a month, you're going to be earning 60%. So you're now earning 60% and you've halved the risk of following that particular trader. Some traders would say, yeah, so I'm even happy with 30% a month, so they would halve it again. So they would go for 25% of what the trader's lots are. So that's a typical example how you can use it in practice to reduce your risk to a particular trader. The other way is also possible. So you would take a trader like this particular one, which is link 06 here, that's only producing 12% a month, but the drawdown is phenomenally low. So what you would say is, I'm happy to take more risk with this particular signal provider. And what you would do is, if the signal provider says trade one lot, you'd double it, or you'd increase it to a level that you're comfortable with. And let's say you double it. So what you can expect is returns that are double, which is now 24%, but your drawdown level will still be under control because the drawdown level is low. So those are ways that you can use increasing and decreasing lots to manage your risk using the linked service that will be coming available in the next 2 to 3 weeks. So now let's look at the next tool to manage risk. And this is most probably the most misunderstood tool that even experienced traders do not fully manage well. Let's say there's a technique that has a drawdown shown over a fairly long period of $2,000 on a $10,000 account. So the drawdown for that technique is 20%. Now, a lot of traders would say, oh, the drawdown's too high, I'm not going to trade this technique. But there are two ways of managing that particular scenario. So let's say, instead of using a $10,000 account, you're using a $5,000 account. Now, this is the mistake that the majority of traders do. They increase their risk by using smaller accounts. Now, as you can see, $2,000 suddenly becomes 40% drawdown compared to a $5,000 account. So you have increased your risk. Very, very bad. But that's what a lot of traders do. They take settings that belong to a $10,000 account and they try and trade it with a $300 account. And they are guaranteed to blow their account. The opposite is what experienced traders do. And what they do is they say, okay, I love this technique. It's producing a lot of money. What I'm going to do is I'm going to take the risk out of the technique by increasing my account size. So they would go in with an account size of $20,000. That would drop the drawdown to 10%, which is a more manageable percentage. Very few traders use these techniques to manage risk. In fact, as I've mentioned, most people blow their accounts because they don't understand the relationship between risk and account size. Again, if we take those examples that we've just looked at, we look at this example I've looked at before, where this link 05, where the return is 120% a month on a $10,000 account now, but the drawdown is pretty high. So what an experienced trader would do is say, I love the fact that I'm doubling my money every month consistently, and therefore I would like to take part in this, but I'm a bit nervous about this high drawdown. So what I'm going to do is I'm going to increase my account. I might make it 20,000. Now what that would do, it will again drop your gains down to 60%, but 60% is still a huge gain on a monthly basis. So that's an example of using the account size to manage risk. Now the same thing as we looked earlier at link 0.06, low return there, low drawdown. So what this is saying is that this account can be traded with a smaller account. So the trader would go and change the account size to maybe $5,000, and the income would go to 24%, and you are still don't have problems with drawdowns. So that's how you use the account size to increase your risk or decrease your risk or increase your income, as is shown in the last example. Now, these concepts are not one-time adjustments that traders make. They are dynamic. So what happens is that, let's say you're a beginner. So when you're a beginner, you want to lower your risk as much as possible. So you would lower your lot sizes as low as you can possibly get them when you're trading. But as you gain confidence, you would slowly increase your lot sizes and increase your account sizing to manage risk better in that way. And over time, if you become very experienced trading, your lot sizing will increase even more, and your account sizing will go according to your risk needs. Even experienced traders do this. What they do, they look at a technique, it's a new technique, it's a new signal that they want to follow. They're not sure about the risk, so they lower the risk initially by either increasing the account size or decreasing the lot size. Once they have confidence, they slowly move the lot sizes up, and once they've achieve good success on increased lot sizing, they actually increase the account size, because that will let them sleep very nicely in the evenings. They don't have to watch that account every day. So these are dynamic concepts that traders use in their trading careers. So you would adapt your lot sizing and position sizing and account sizing accordingly. Now, I hope you've enjoyed this video, and I hope you've learned something about why people blow their accounts. When you see somebody blowing accounts, there are two reasons why they're blowing their accounts. Firstly, their lot sizing was way too aggressive, and secondly, their account was too small. So they were trading a $300 account using $10,000 settings, that type of thing, guaranteed to lose, and they would then say that the robot is a scam, but they don't realize they have not applied the correct position sizing or account sizing. We always provide account sizing and position sizing with our robots. So for more information about the linking service, please use the link provided. The linking service is free to our paid forum members. You can join the forum from as little as $17 a month on an annual basis, or $39 a month on a monthly basis. The link to the paid forum will be in the description, as well as in the first commentary of this video. So from me, Alex Deploy, cheerio.